Gupta, Research Director of CISDM, an Alternative Investments Research Center at the University of Massachusetts, and also the founding co-sponsor of the Chartered Alternative Investment Analysts Association. We're very pleased to have Dr. Angelo Calvello join us today. Dr. Calvello has had a distinguished career in environmental investing, and he's also the author of Environmental Alpha. He's also the editor of the Journal of Environmental Investing, and we're going to talk about environmental alpha issues today in great detail. Dr. Calvello, welcome.
Thank you, Raj. Good to be here.
Now, let's get into the drivers of risk and return. Let's start with defining the return sources, and then maybe we could get into the drivers of risk.
Okay. The drivers of return in the environmental space ultimately start with the science. And science, I'm not going to argue science pro and con and the climate deniers. I'm going to say the body of science that's out there that's been peer-reviewed is determined what I think is the following. First, greenhouse gases in the atmosphere have risen over the last 150 years, from about 280 to where we are today of about 385 parts per million CO2 equivalent. This is the result of human activity, economic activity. Scientists now see that we will be approaching a threshold, and some say we've already approached that threshold, others say it might be 450 parts per million, might be beyond that. But science tells us that the more greenhouse gases we put in the air, the more likely we'll experience an increase in temperature. As temperature rises, we will have changes in our environment. Changes in weather pattern, hydrological cycle, disease vectors, etc. Science will then works to determine what is the upper boundary. Is it 350 parts per million? Is it 450 parts per million? I don't know. But science gives us a sense of what that boundary is, that we don't want to transgress, so we don't have an increase in temperature above 2 degrees Celsius from pre-industrial times. With that knowledge, takes us to the second driver, economics. I'll make this quite simple, not for you, but for me, because it's a Saturday morning. The economist can then say, the economist will then say, we approach this level of this threshold of parts per million. If we breach it, there will be a cost because of these changes in the natural world will result in changes in the societal world. They'll also say if we try not to breach that level, if we try to mitigate greenhouse gas emissions, there's a cost for that also, because we're going to have to change the way we act. So the economists will tell us if we follow a business as usual course, there's a certain cost. And if we try to mitigate greenhouse gases, there's a cost for that as well. With those cost estimates comes the third driver, policy. Regulators, policymakers can then say, what type of action do we want to encourage? And if we want to encourage mitigation, then we will put in certain types of incentives or penalties that will ultimately change behavior of individuals and of corporations, so they emit fewer greenhouse gases. They'll know, in general, they'll know the cost of those decisions. But once we have policy that is loud, long, and legal, people will then commit capital to create these technologies that will mitigate greenhouse gases. They will also commit capital to technologies that will allow us to adapt to those greenhouse gases that are already in the pipeline, because greenhouse gases have a certain convexity, and just because we stop emitting now doesn't mean we're okay. There's still greenhouse gases in the pipeline. So people will commit capital to create these technologies. Ultimately, those are the environmental investments that you and I will choose from. So the drivers, science, economics, policy, and technology. The risks are the same. I mean, it's kind of the flip side, because there are risks related to the science. If there are changes in the models, the global warming models, the hydrological models, if we're wrong in estimating the depth of the thickness of the greenhouse shelf, that will impact other decisions in terms of the economics, the policy, and the technology. Likewise, the economics can be wrong, but certainly the biggest risk in this space is policy. We see that clearly in the U.S. We don't have a clear policy in the U.S., and because the technologies and the capital associated with those technologies are incredibly expensive, you need to have these very clear long-term policies in place. So that's a huge risk. Final risk, obviously, technology. A disruptive technology comes in, and suddenly the way we were approaching solar is no longer cost-effective. A new technology comes in, very disruptive. So both sides of the coin. That was a long answer, but
No, that was good. Now, let me actually follow up on the policy issue, because I think that's very important. And we've seen regulators fall down on the job on numerous occasions, Bernie Madoff and what have you. Do you think the regulators are approaching this in the right way, or are they being educated about environmental issues?
are you speaking specifically about the U.S.?
Yeah.
Yeah. Because the U.S. is a bit behind things right now. I think the U.S. policymakers have the information they need, but I don't think they have the fortitude to make the decisions right now, because they're worried it will impact the economy. They're not seeing the long-term benefits of putting these policies in place.
And what about Europe and Asia?
Europe and Asia are farther along than we are. If you just look at the commitments the EU has made and some of the Asian countries have made, they're much farther along. They do have policies in place that provide the correct incentives and guidelines to mitigate and adapt.